Here is something nobody tells you about building wealth. The moment you get close to actual success is exactly when most people blow themselves up. Not because they stop earning, not because the market crashes, but because they hit a psychological threshold they never saw coming. A threshold that rewires how they think about money, risk, and success without them even noticing it is happening. That threshold is $250,000 in invested assets, and it might be the most dangerous number in all of personal finance. I am Leo, and I've spent an unhealthy amount of time studying why some people turn modest incomes into genuine wealth while others, often earning way more, never seem to break through to real financial security. And what I've discovered is that wealth building isn't linear. There are specific dollar amounts where everything shifts, where the entire game changes, where people who've been doing everything right suddenly start making catastrophic mistakes. $250,000 is the big one. And if you don't understand why, it will absolutely wreck you. Most people think wealth building works like climbing stairs. Save $10,000, you are $10,000 richer. Save $50,000, you are $50,000 richer. Simple addition, right? But that is not how it actually works. There are inflection points, specific thresholds where the psychology of money shifts so dramatically that your entire relationship with wealth gets turned inside out. And here's what makes $250,000 so particularly vicious. It is the exact moment wealth stops feeling theoretical and starts feeling real. This is when your money begins moving faster than you do. One good market day can earn you more than your entire weekly paycheck. One strong month can generate more passive gains than some people make working full-time. But, and this is critical, it is also the point where one bad decision can erase years of disciplined progress in a matter of months. Think about the stakes for a second. When you have $5,000 invested and the market drops 10, you lose $500. That sucks, sure, but it is not life-altering. You can recover in a month or two of additional savings. When you have $250,000 invested and the market drops 10, you just lost $25,000. That is more than the median American saves in an entire year. Suddenly the stakes aren't just higher. They're in a completely different universe. But here's what is really dangerous about hitting $250,000. It is not the potential losses that destroy people. It is something way more subtle and infinitely more destructive. It is what happens inside your head. There is this psychological phenomenon that kicks in at this exact wealth level. I call it the illusion of arrival. You start seeing your portfolio jump $6,000 in a single day. Your brain immediately starts recalibrating what feels normal. You check your account on a Tuesday morning and boom, you are up $7,500 overnight. And your brain starts playing this insidious game. $7,500 in one day. That is more than I used to make in an entire month at my first job. Clearly I figured something out. Clearly I am doing something right. Clearly I deserve to celebrate. Maybe it is time for that European vacation you've been putting off. Maybe you should finally upgrade to a nicer car after all. You are basically wealthy now, right? Wrong. Dead wrong. And this is where the $250,000 threshold becomes absolutely ruthless. Here is what is actually happening at $250,000 that most people completely miss. You are not rich. You are not even close to rich. What you are is dangerous. Dangerous to yourself, dangerous to your financial future, and dangerous to the wealth you've spent years building. You have just enough money to make really expensive mistakes, but not enough money to recover from them easily. That $7,500 gain you saw, it is unrealized. It exists only in the digital realm of your brokerage account. It can vanish tomorrow just as quickly as it appeared. But that $12,000 vacation you are considering, that is very real, very permanent, and very capable of setting your wealth-building journey back by a year or more when you factor in compound interest. This is what I call the dangerous illusion that materializes at $250,000, the illusion of wealth before you are actually wealthy. And it destroys more financial futures than market crashes, recessions, and bad investment advice combined. But wait, the psychological traps don't stop there. There is another monster lurking at the $250,000 mark. And this one might be even more destructive. I call it the overconfidence monster. Here's how it works. You've managed to accumulate $250,000 through some combination of consistent saving, disciplined investing, and maybe some market luck. Your portfolio has grown steadily for several years. You've weathered a few market downturns and came out fine. You start thinking you really understand how this whole wealth building thing works. You start believing you are some kind of investing genius. This is when people go completely off the rails. This is when conservative index fund investors suddenly think they can pick individual stocks. This is when people start dabbling in options trading. This is when they start chasing whatever stock Reddit is pumping that week. This is when they start throwing money at speculative real estate deals or their buddy's startup. This is when the phrase, "I can afford to lose this," becomes the most financially destructive sentence in the English language. The cruel irony is that at $250,000, you finally have enough money to make the kind of mistakes that can set you back half a decade. You can afford to lose $15,000 on a bad stock pick. You can afford to gamble $20,000 on cryptocurrency. You can afford to invest $40,000 in your friend's business idea. The problem is that being able to technically afford losing money and actually being able to afford the OP, opportunity cost of losing money, are two completely different things. One bad decision at this wealth level can delete 3 to 5 years of compound growth. Think about that. 5 years of disciplined saving, 5 years of consistent investing, 5 years of delayed gratification. All wiped out because you thought you were smarter than the market. And here is the kicker. The bigger your account gets, the more confident you become, and the bigger the mistakes you are willing to make. It is psychological quicksand. The more you struggle, the deeper you sink. But there is yet another trap waiting at $250,000. And this might be the quietest killer of all. It is what I call the comparison trap. You finally reach $250,000 invested, and for a brief moment, you feel successful. You feel accomplished. You look around at friends and coworkers who are living paycheck to paycheck, and you feel pretty good about where you are. Then something happens. You meet someone at a work event who casually mentions they have $600,000 invested. Suddenly, your $250,000 doesn't feel so impressive. Then you read an article about someone your age who has already hit $900,000. Now you feel behind. Then you stumble across a social media post from someone flaunting their $2.5 million portfolio. And suddenly you feel like a complete failure. This is where people sabotage their own progress trying to catch up. They abandon their conservative, steady approach and start chasing higher returns. They increase their risk tolerance beyond rational limits. They start making desperate moves to close the gap between where they are and where they think they should be. The comparison trap is particularly vicious because it is never ending. There will always be someone with more money than you. Always, even billionaires compare themselves to other billionaires. But here is what makes the comparison trap so insidious at $250,000. It is not just about feeling bad. It is about the specific financial behaviors it triggers at this exact wealth level. When you have $50,000 invested, comparing yourself to someone with $1 million doesn't really change your strategy. You are still focused on basics, still saving what you can, still learning fundamentals, but at $250,000, that is when you have just enough money to make genuinely stupid decisions in the name of catching up. This is when people start leveraging their portfolios. This is when they take out home equity loans to invest in the stock market. This is when they convince themselves that taking on debt to invest is strategic. After all, if the market historically returns 10 and you can borrow at 5, that is free money, right? Wrong. That is how you turn a temporary setback into a permanent catastrophe. I've watched people with solid $250,000 portfolios completely destroy themselves trying to accelerate their timeline. They'll see someone bragging about making 6 figures in crypto and decide they need to allocate $50,000 to digital assets. They'll hear about someone doubling their money in real estate and suddenly think they need to become landlords. They'll read about day traders making thousands weekly and decide their boring index funds aren't cutting it anymore. The brutal truth is this: at $250,000, you are at the single most dangerous point in your entire wealth building journey. You have enough money to seriously hurt yourself, but not enough to protect yourself from your own bad decisions. But let me tell you something that might surprise you, something that financial advisors and wealth building gurus rarely mention because it doesn't sell courses or generate fees. The real secret about hitting $250,000 isn't what you should start doing differently, it is what you should absolutely not do. Here is the thing. Nobody tells you, when you cross the $250,000 threshold, you don't need to get fancy. You don't need to start picking individual stocks. You don't need to diversify into REITs or commodity funds or international emerging markets. You don't need to hire a financial advisor who is going to charge you one annually to tell you to keep doing exactly what you are already doing. What you need is something that sounds almost insultingly boring. You need to keep doing exactly what got you to $250,000 in the first place. But here is why that is so incredibly hard. Continuing to do the same boring thing when your account balance is jumping around by thousands of dollars every day feels like you are not maximizing your potential. It feels like you are leaving money on the table. Your brain starts playing this cruel game where it shows you all the opportunities you are supposedly missing. Look at that stock that went up 400 last year. Look at that real estate deal that would have tripled your money. Look at that cryptocurrency that made people millionaires overnight. Surely, with your $250,000 foundation, you could afford to take some of those risks, right? This is the exact moment where discipline becomes more valuable than intelligence. This is where the ability to ignore noise becomes more important than the ability to analyze opportunities. This is where boring becomes beautiful. Because here is what actually happens when you stay boring at $250,000. Something magical occurs that most people never get to experience because they sabotage themselves first. Your money starts working harder than you do. Let me show you some math that will completely change how you think about this milestone. If you have $250,000 invested earning 8 annually, that is $20,000 in growth per year. $20,000. That is more than some people save in their entire lifetime. And your money is generating that much every single year without you doing anything. But it gets better because of compound interest. That $20,000 in growth starts earning its own returns. Next year, you are not earning 8 on $250,000. You are earning 8 on $270,000. The year after that, 8 on $291,600. The growth starts snowballing in ways that will genuinely shock you if you've never seen it happen before. Here's the part that will blow your mind. From $250,000 to $500,000 takes roughly half the time it took you to get from $0 to $250,000. Read that again. The second $250,000 comes twice as fast as the first, and the $250,000 after that comes even faster. This is why I call $250,000 the point of no return. Not because you can't lose money from here, you absolutely can. But because if you can resist the psychological traps at this level, building serious wealth becomes almost inevitable. Your money develops momentum that becomes increasingly difficult to stop. But there is something else that happens at $250,000 that nobody talks about. Something that has nothing to do with compound interest or market returns. You gain options. When you have $250,000 invested, you are no longer completely trapped by your paycheck, the way most people are. You can't retire on it, obviously. But you can make career moves that people living paycheck to paycheck simply cannot consider. You can take a temporary pay cut to join a startup with serious equity upside. You can negotiate way more aggressively with your current employer, because walking away isn't financial suicide. You can relocate for better opportunities without worrying about covering moving expenses. This is the hidden power of $250,000. It is not just about the money itself. It is about the freedom that money provides to make decisions based on opportunity rather than desperation. And these decisions, these career moves and calculated risks that become possible at this wealth level, often accelerate your income growth far beyond what your investments alone could achieve. Think about this. You've spent years building discipline, learning to live below your means, consistently investing. You've developed what most people never develop, the ability to delay gratification. But now, ironically, that discipline becomes harder to maintain when the rewards get bigger. It is like learning to drive in a Honda Civic and then being handed the keys to a Ferrari. Same basic skills, completely different stakes. This is why so many people stumble right at the $250,000 mark. They mistake having options for having unlimited options. They confuse being strategic with being reckless. They think because they can afford to lose $10,000, they should be willing to risk it. But here is the brutal truth about this wealth level. Every dollar you lose now costs you approximately $4 in future wealth due to compound interest. That $10,000 mistake today becomes a $40,000 mistake 20 years from now. Let me share something counterintuitive. The secret to navigating the $250,000 threshold isn't learning new strategies. It is unlearning the need to be clever. The biggest winners at this level are often the most boring people you'd never want to sit next to at a dinner party. They keep buying the same index funds, keep living in the same reasonable house, keep driving the same reliable car, keep doing the same boring things that got them here in the first place. But staying boring requires something surprisingly difficult when your net worth is jumping around by thousands every month. It requires ignoring the voice in your head saying you are not maximizing your potential. It requires accepting that slow and steady really does win the race, even when the race feels like it should be more exciting by now. Here is where the math gets really interesting. Most people think of $250,000 as being 1/4 of the way to $1 million, but compound interest doesn't work like that. In terms of time, $250,000 is actually halfway to becoming a millionaire. Let me break this down because the numbers are genuinely mind-blowing. If you are consistently investing $10,000 per year at 8 returns, it takes about 14 years to reach your first $250,000. But here is the kicker. It takes roughly another 14 years to go from $250,000 to $1 million. The same amount of time for 4 times as much money. This is the moment compound interest stops whispering and starts shouting. Your money has finally built enough momentum to roll downhill without you constantly pushing the boulder uphill. But knowing this creates its own psychological trap. When you realize you are halfway to millionaire status in terms of time, it can trigger what I call acceleration anxiety. You start thinking, there must be something you can do to speed up the process. Maybe you should increase your risk tolerance. Maybe you should start picking individual stocks. Maybe you should leverage your portfolio with borrowed money to really supercharge your returns. This is exactly backwards thinking. At $250,000, your job isn't to accelerate the process. Your job is to not screw it up. Your money has reached escape velocity. It is generating its own momentum. The worst thing you can do is interfere with that momentum by getting creative. The difference between people who build lasting wealth and those who sabotage themselves at this level comes down to understanding one simple truth. The hardest part wasn't getting to $250,000. The hardest part is not destroying it on your way to becoming a millionaire. So stay boring, stay disciplined, ignore the noise, ignore the comparison trap, ignore the overconfidence monster, ignore the illusion of arrival. Let compound interest do what it does best, because you are not 1/4 of the way there. You are halfway there. And the only way you don't make it is if you blow yourself up trying to get there faster. If this changed how you think about the $250,000 milestone, hit that subscribe button. I break down the psychology and mathematics of real wealth building every week because understanding these inflection points is what separates people who build lasting wealth from people who sabotage themselves right before winning. I am not a financial advisor, mortgage expert, or licensed financial professional. The content on this channel represents personal opinions only and is intended for educational and entertainment purposes. Please conduct your own research and seek professional guidance before making any major financial decisions. See you next time.